Imagine waking up one morning in 2026 to discover that everything you thought was safe wasn't. Banks still open, but your withdrawal limit is quietly reduced. Markets still trading, but half the liquidity simply vanished. The news anchors keep smiling, but governments hold midnight emergency meetings behind closed doors. And here's the part no one is ready for. By the time the public realizes a crash is happening, the people who caused it will already be protected. Because right now, today, the most powerful financial institutions on earth are bracing for something they are not warning you about. A correction? Recession? No, something deeper. A systemic break, quietly labeled in official documents as a monetary realignment event. This video is about that event, the patterns, the signals, and the preparations, and why history suggests the crash of 2026 won't be an accident, but an outcome. Welcome to the Fiscal Archivist. Every financial collapse begins long before the public feels it. To understand 2026, we must rewind decades, back to the moment global finance became addicted to debt. After the 2008 crisis, central banks learned a dangerous lesson. If you flood the system with enough cheap money, markets always bounce back. Stocks recover, banks survive, governments look smart. But there was a silent cost. Every fix required even more borrowing, more liquidity, more artificial stability than the last time. By 2020, the world entered what economists call the debt dependency loop. Growth wasn't coming from real productivity, it was coming from printing. Then inflation arrived. Governments blamed supply chains. They blamed pandemics. They blamed wars. But the truth is simpler. If you print trillions in new money, the value of old money collapses. And when inflation hit levels not seen in 40 years, central banks switched strategies. They began aggressively raising interest rates, the fastest hikes in modern history, hoping to undo years of excess. Except, there was a problem. The world wasn't built for high interest rates anymore. Throughout 2021 to 2024, major global systems began quietly cracking. Bond markets, the backbone of everything, became unstable. The UK nearly collapsed in 2022. Japan's central bank intervened hundreds of times. Italy's debt became unmanageable. The US saw a historic bank run in 2023. Silicon Valley Bank, Signature Bank, First Republic, now gone in days. Not because of bad loans, but because rising interest rates destroyed their balance sheets. China's property giants started collapsing. Evergrande, Country Garden, dozens more. Together, they controlled 70% of Chinese household wealth. Global shipping, insurance, and commodity markets became unstable storms in one region, sanctions in another, droughts in a third. Everything became unpredictable. And yet markets kept rising. Why? Because central banks, governments, the financial elite were doing something quietly behind the scenes. They were preparing. A financial crash doesn't happen when things get worse. It happens when the systems designed to hide the damage finally fail. And right now, 3 specific pressure points are converging, all pointing to 2026. 1. The debt supercycle is ending. Global debt has smashed through $350 trillion, more than 3 times global GDP. But here's the part hidden beneath the headlines. $100 trillion of that debt must be refinanced by late 2026. But refinancing at higher interest rates means governments pay more, corporations pay more, households pay more. Something has to break. And historically, it always does. 2. The US election gives global market shockwave. Every major financial crisis of the past 50 years has followed a predictable pattern. Massive deficits, plus political chaos, plus interest rate pressure. 2026 is the year the US post-election financial decisions collide with reality. Whoever wins will inherit a $36 minus 40 trillion national debt, interest payments larger than the entire military budget. An exhausted bond market, a Federal Reserve unable to cut rates without reigniting inflation. This is the exact recipe that triggered past collapses. 1973, 1987, 2000, 2008, 2020, every one of them followed the same curve. 3. Central banks are buying gold at wartime levels. This is the most suspicious signal of all. In the past 2 years, central banks have bought more gold than in any period since the 1950s. When nations prepared for a new global currency system, gold is not an investment, it is insurance. Insurance against exactly one thing: currency failure. So ask yourself, why are the institutions that print the money buying protection from their own money? They know something. They always do. The crash of 2026, if it unfolds as the indicators suggest, will not look like 2008. It will be slower, more controlled, more managed, more engineered. This is how it unfolds. 1. Markets freeze before they fall, liquidity dries up. Brokers widen spreads. Banks quietly limit withdrawals. By the time the public panics, insiders already moved. 2. Debt markets seize, governments scramble to issue bonds. Investors demand higher yields. Interest payments explode. 3. Corporate defaults begin, not tiny companies, large ones. Ones that rely on cheap debt, real estate, tech, airlines, manufacturers. For governments intervene, but unlike 2008, they cannot simply print unlimited money. Inflation has made that impossible. So they will choose a different solution: a controlled financial reset, a monetary realignment, a new framework for money itself. Call it what you want: a digital currency era, a new reserve system, or a quiet default. The result is always the same. Old money loses value, new money gains rules, and the public pays the price. This is not the first time we've been here. In 1929, the US ignored rising leverage, gives collapse. 1971, the dollar became unstable, gives Nixon closed the gold window. In 2008, debt spiraled, gives global meltdown. In 2020, money printing exploded, gives inflation crisis. In 2026, the cycle reaches its logical conclusion. At every stage, those at the top prepared first. Those in the middle suffered most. Those at the bottom didn't even know what happened. The warning signs were always visible, but only to those who knew where to look. At the core of every financial meltdown lies a truth most people never hear. Crashes aren't random events. They are the outcome of decades of distorted incentives piling up until the system can no longer hold its own weight. Any economy that depends on endless growth, endless borrowing, and endless confidence to survive is already living on borrowed time. That is why the institutions preparing for 2026 aren't reacting to surprise risks. They are anticipating the next turn of a cycle they've seen before. The sudden wave of central bank gold accumulation, the quiet withdrawal of liquidity from global markets, the tightening of debt refinancing windows. None of it is accidental. These moves aren't warnings, they are preparations. And when the next crisis arrives, it won't destroy the financial system, it will reshape it. Old currencies will fade, old debts will be rewritten, and the outdated rules holding the current structure together will be replaced with something new. Something designed by the same architects who benefited from the last collapse. The question isn't whether the system will change. It's who that change will serve. No empire survives its own debt. No monetary system lasts forever. 2026 may not be the end. But it will be the moment the illusion breaks. The moment people realize the system is not designed to protect them. It is designed to protect itself. If you want to understand the forces shaping your money, your future, and your freedom, subscribe to the Fiscal Archivist, because the next crisis is not coming. It's already unfolding.